Silver was at $96 yesterday. Right now it is sitting at $80, 16% gone in less than 24 hours. And here's what makes this so extraordinary. This did not happen on a quiet Monday. This did not happen when markets were calm. This happened while US and Israeli forces are actively striking targets across Tehran, Isfahan, Qom, Karaj, and Kermanshah. This happened while the Revolutionary Guard Corps is broadcasting on maritime radio that the Strait of Hormuz is closed. This happened while the most significant military operation in the Middle East in decades is actively running. Silver crashed 16% during the exact war that was supposed to send it to $150. Now, the lazy take, the one you're going to see plastered all over financial social media today, is that silver broke, that the move is over, that $121 was the top, and this is the unwind. That take is wrong. And I am going to show you exactly why with data. Not opinion, not hopium, data. But before I get into the numbers, I want to address something directly, because the mainstream financial media is going to tell you one story about what happened today. And I am going to show you a completely different story, a more accurate one, the one that actually explains what the data is telling us right now. So stay with me, because by the end of this video, you are going to understand today's crash in a way that almost nobody in the silver market is talking about right now. And that understanding is going to change how you look at every single price move in this market for the rest of this year. Let me start with the actual cause, not the narrative, the actual mechanical cause. Silver did not crash today because the war is ending. Silver did not crash because the physical market collapsed. Silver did not crash because a single supply or demand condition in this market changed overnight. Not one fundamental shifted in the last 24 hours. Silver crashed because of two numbers that have absolutely nothing to do with silver. Number one, the US dollar index hit 97.87 to 98.43 today. That is the strongest dollar reading since January the 20th. Number two, the US 10-year Treasury yield rose to 4.07%, up 10 basis points in one session. That is it. That is the complete cause of a 16% crash in silver. Two macro numbers outside the silver market entirely. Now let me show you why those two numbers hit silver so hard, because this is the part that the mainstream coverage skips. Silver is priced in US dollars on every single exchange in the world, every ounce, every futures contract, every physical delivery, all denominated in dollars. So when the dollar surges like it did today, here is what happens. A European solar manufacturer who needs to buy silver has to pay more euros to get the same dollar amount. An Asian institution buying silver for their vault has to spend more yen. A sovereign fund in Singapore has to deploy more of their local currency. Real time, across every non-US buyer simultaneously, the cost of owning silver just went up. Demand softens. Price falls, mechanically, automatically. And the 10-year Treasury yield at 4.7% adds a second layer of pressure. Here is how that works. Silver pays you nothing to hold it. A US Treasury bond pays you 4.07% annually with essentially zero risk. When that yield gap widens in a single session, institutional portfolio models start rebalancing. Some allocation shifts from silver into treasuries. The selling is not a verdict on silver. It is a mechanical adjustment triggered by a yield number. Two numbers, DXY at 98, 10-year at 407. That is the entire explanation for $96 becoming $80 in 24 hours. And here's the key question, the one that everything else in this video flows from. Why did the dollar surge today? During an active war, during an oil supply shock, during the most significant geopolitical event in the Middle East in a generation. Why would the world's reserve currency strengthen when the country issuing it is at war in the region that controls 20% of global oil supply? This is the paradox at the center of today's move. And if you understand this, you understand exactly where silver goes from here. When geopolitical risk spikes acutely, and I mean acutely, not gradually, not over weeks, but in a single 24-hour window, the way it did when Khamenei was killed and the Hormuz was declared closed, global institutions run a specific playbook. They reduce local currency exposure. They sell emerging market positions. They convert into US dollars, not because US fundamentals improved, not because the dollar deserved to rally, because the US dollar is still the deepest, most liquid emergency reserve asset on Earth. In the first 24 to 48 hours of a major shock, every institution in Europe, Asia, and the emerging markets runs through the same door at the same time. That flow is mechanical, it is reflexive, and it is temporary. Here is what history shows us about this exact pattern. After September 11th, 2001, the dollar surged in the first week as institutions globally reduced risk. Within 30 days, that surge had reversed. After the Iraq invasion in March 2003, the dollar strengthened acutely in the opening days of the conflict. Within 6 weeks, the medium-term inflationary and fiscal implications of a prolonged military engagement had driven it back down. After the 2014 Russia-Ukraine escalation, the dollar's first week strength was followed by a protracted weakening as commodity price inflation from the conflict dominated the medium-term narrative. The pattern is consistent across every major modern geopolitical shock. Acute dollar strength in the first 24 to 72 hours. Then the fade, then the medium-term consequences, inflation, supply disruption, fiscal pressure, drive the real directional move. Today is the first 24 hours, the acute phase, the phase where dollar strength hits silver. Silver at $80 is the first phase price. The second phase, the inflation repricing, the dollar fade, the structural supply story reasserting itself. That is the phase that Citigroup priced when they set their $150 target. That is the phase that Bank of America priced when they put $130 on 2026. That is the phase that the sixth consecutive annual deficit, the drained COMEX vault, and the China export restriction all point toward. The paper market is in phase 1. The physical market is already looking at phase 2. Now let me show you the leverage dynamic in this market, because this is the single most important thing to understand about a 16% silver session. Gold fell approximately 2 to 3% from its overnight high today. That is a meaningful move for gold, but silver fell 16% on the same catalyst. That is roughly a 5 to 6 times multiplier. That multiplier is not silver being weak. It is the structural math of market size. Silver's total market capitalization is approximately 1/20th, the size of gold's in dollar terms. The same volume of institutional flow that moves gold 3% moves silver 16% every time, in both directions, without exception. This is the identical mechanism that gave silver a 147% gain in 2025, while gold gained 67%. The same leverage, the same math, the same market structure. And it works exactly as powerfully on the downside as it does on the upside. There is no version of this market where you get the 147% upside leverage without the 16% downside session. They are the same thing, same coin, two sides. The investors who captured silver's 147% gain last year were not exempt from days like today. They were accepting days like today as the price of admission, because when the leverage works in your direction, a 3% gold move becomes a 16% silver gain. When it works against you, a 3% gold decline becomes a 16% silver crash. That is the deal this market offers. Every single person in it knows that deal. Now let me show you what did not change today, because this is the part of the story that the paper price at $80 is temporarily ignoring. And the gap between what the paper price says and what the physical reality says is where the real information lives. The COMEX registered silver vault, still sitting below 86 million ounces, still draining at 785,000 ounces every trading day, still down 75% from the 346 million ounces it held in 2020. The dollar index going to 98 did not put one single ounce back into that vault, not one. The physical delivery rate. February 2026 saw 98% of COMEX silver futures contracts result in actual physical delivery. The historical normal is 2 to 5%. The institutions holding those contracts said, at $90, at $95 during a parabolic move, give me the bars, not cash, not a paper settlement. The bars. Those bars are now in private vaults. They did not come back because the dollar strengthened today. The sixth consecutive annual deficit. The Silver Institute confirmed 67 million ounces of structural shortfall for 2026. Every year since 2021, the world has consumed more silver than miners have produced. The cumulative shortfall approaching 400 million ounces since 2021. Today's dollar move did not produce one additional ounce of mine supply. The deficit is still running. China's 44-company export restriction, in force since January 1st, 2026, cutting 30 to 40% of global refined silver supply from the international market for 62 days straight, as of today. Right now, still fully in force. The DKY at 98.43 did not change Beijing's classification of silver as a strategic material. And the war itself. This is the one that the lazy crash narrative ignores most completely. The IRGC senior advisor told Reuters, today, while silver was crashing, directly, the Strait of Hormuz is closed. If anyone tries to pass, the Revolutionary Guards and the regular Navy will set those ships ablaze. That statement was made today, while silver was dropping from $80 to $80. The war premium did not leave this market. It pulled back from an overstretched $96 high. Those are different things. Not one structural condition that built this move changed today. Not one. The paper price moved because of two macro numbers. The physical reality stayed exactly where it was when silver was at $96 yesterday. And here is what that divergence means for where silver goes next. Paper and physical diverge regularly in this market, and they always resolve in the direction of the physical. Because you cannot fill a production order with a futures contract. You cannot build a solar panel with a DXY reading. You cannot put a dollar index level into an EV battery management system. The industrial buyer who needs 5,000 ounces for next week's production run does not care what the 10-year yield printed this morning. They need the metal. Now let me walk you through the technical picture. Because the $80 level matters, and it matters for a specific reason that goes beyond the chart. Through late 2025, $80 was a ceiling. Silver tested it through October, November, early December, failed at it multiple times, built a base underneath it for weeks, then broke through it with conviction in late November when the physical delivery data and institutional accumulation finally overwhelmed the sellers. When silver broke above $80 and held, that level converted. Ceiling became floor, former resistance became support. The buyers who accumulated in the 70s have their cost basis there. The institutions that positioned below $80 are not selling at $80 because the dollar surged for one session. Their thesis has not changed. Their cost basis is still well below where silver is trading right now. The concentration of institutional positions with cost basis below $80 is the structural reason this level acts as support. It is not just a line on a chart. It is the physical reality of where real capital entered this market. Right now, silver is sitting exactly at $80, testing that level in real time. A sustained daily close below $80, not an intraday wick, not a flash print, a real close, changes the structure. It opens pressure on those long positions. Technical analysts at LSEG identified $70 as the next meaningful support, the December 2025 consolidation range. Below that, the 200-day exponential moving average sits near $55. Those are the real downside levels if $80 gives way with conviction. But here is what makes $80 defensible right now. The war is not over. Negotiations have not started. Iran has not surrendered. Iran has not agreed to ceasefire terms. The Strait of Hormuz is still broadcasting closure. U.S. military operations are still actively destroying IRGC command posts, Iranian air defense installations, and missile launch sites as I record this. The geopolitical premium that drove silver from $89 to $96.40 has not been removed. It pulled back because of a currency move. That is different from being removed. And the difference between those two things is the difference between a temporary correction and the end of a move. Now let me take you back through the full context of what this market has done. Because context is everything when you're watching a 16% session. 14 months ago, silver was in the low 30s. Let that sit for a second. $30. That is where this started. Through all of 2025, silver gained 147%, the strongest annual performance since 1979. Every single structural condition we track, the deficit, the vault drain, the China restriction, the industrial demand surge, all of it building simultaneously, institutions accumulating, ETF inflows hitting 187 million ounces in a single year, COMEX physical delivery rates climbing month after month. Then on January 29th, 2026, silver hit $121.67, a new all-time nominal high. The RSI at that moment was 93.86, the most overbought reading since 1980, parabolic, extended, vulnerable to a correction. The correction came the next day. On January 30th, Kevin Warsh was nominated as Federal Reserve Chair. The dollar surged. Silver futures crashed 31.4%, settled at $78.53, the worst single trading day since March 1980, 46 years. Forced liquidation of $3.5 billion in the largest silver ETF alone. Spot silver touched $63 to $67, depending on the venue. And then something happened that every person in this market needs to understand deeply. The physical market came back. Industrial manufacturers who had paused buying above $100 came back at $80. Solar panel producers, EV component manufacturers, defense contractors, the people who need silver for actual production, not for speculation, not for momentum trading, came back with real orders at real prices because their production schedules do not have a pause button, because the sixth consecutive annual deficit does not disappear because of a margin cascade, because the COMEX vault at 86 million ounces does not refill because of a currency shock. Silver recovered from $63 to $96.40 in 6 weeks. A 53% recovery before the war started, before Khamenei was killed, before the Hormuz was closed. The physical market pulled it back on the strength of the supply deficit story alone, and now it is at $80 again, same level it crashed through in January, same level it recovered through in February, same level the physical buyers defended on the way back up. Every single time this market has tested $80, it has found buyers. Not because $80 is a magic number on a chart, because $80 is below the cost basis of every institution that has been systematically accumulating physical silver since this structural story became undeniable. Those buyers are still there. They were there at $63 in January. They will be there at $80 in March. Now let me give you the three scenarios going forward, real ones, with specific numbers, because vague scenarios are not useful. The outcome from $80 is determined by one variable above everything else. I said it in my last two videos, and I'm going to say it again today because it is still true. The Strait of Hormuz. Not the Fed meeting in March, not the next CPI print, not any earnings report, the Strait. That 21-mile wide waterway through which 20% of global oil supply moves every single day. That is the variable. The IRGC said today the strait is closed and any ship that tries to pass will be set on fire. That statement is on record. It has not been walked back. Multiple oil trading firms paused crude shipments through the waterway today in response. The U.S. Navy Central Command issued a maritime warning advisory covering the entire Gulf region. The statement is there. The physical enforcement has not been confirmed yet. That gap between verbal threat and physical enforcement is where the three scenarios live. Scenario 1. The strait stays effectively disrupted through sustained threat. Insurance markets price the risk as real. Tankers continue diverting. Oil holds elevated. And here is what matters for silver specifically. The acute dollar safe haven flow fades within 48 to 72 hours as the shock normalizes into sustained conflict. The DXY rolls from 98 back toward 96 to 97. Treasury yields moderate as recession risk from sustained high oil starts competing with inflation risk in bond market pricing. Silver's two mechanical headwinds, dollar strength and yield pressure, both fade at the same time. The structural supply bid reasserts. Silver recovers from $80 toward $90 to $95 within the week. Citigroup's $150 target is the medium-term destination as the inflation story accumulates month after month. Scenario 2, diplomatic channels produce a ceasefire within 48 to 72 hours. The strait formally reopens. Oil retreats from its shock premium. The geopolitical catalyst that drove silver from $89 to $96 unwinds. Silver loses its war premium and retests the $75 to $78 pre-war accumulation zone. The structural deficit story is fully intact, but without the war catalyst, silver consolidates at those lower levels before resuming its structural uptrend. This is the scenario where $80 breaks on a daily close and $75 to $78 becomes the relevant support. Scenario 3. The war expands. Iran's proxy network activates simultaneously. Hezbollah opens a northern front. Houthi operations intensify. Iraqi militias target U.S. bases. The IRGC moves from broadcasting Hormuz closure to physically enforcing it. A tanker gets hit, a mine gets deployed. IRGC naval vessels physically block commercial shipping. Oil moves to $120, $150. PPI, already at 3.6% core before 1 barrel of Iranian supply was disrupted, adds a full percentage point or more in the next monthly print. The Federal Reserve faces the impossible trap between cutting into an inflation spiral and hiking into a war recession. It does neither. Policy paralysis confirmed. In that scenario, the dollar's acute strength reverses violently as confidence in Fed policy effectiveness collapses. The inflation hedge bid for silver overwhelms every other consideration. The $80 level gets discussed the way people currently discuss the $30 low from early 2025. A data point from the early stage of a move that went somewhere most people did not believe was possible. 2 of those 3 scenarios resolve above $90 within weeks. All 3 of them resolve above the deepest structural support levels. The bear scenario requires the war premium to disappear and the structural thesis to be abandoned simultaneously. Institutional buyers who have been accumulating against a 6th consecutive deficit, a draining vault, and a 98% delivery rate do not abandon that thesis because of a one-day dollar surge. Now here is what to watch in the next 72 hours. And I want to give you specific numbers, not general themes. First signal. Silver's daily close today, not the intraday low, the close. If silver closes above $82 today, buyers defended the $80 test and the floor is holding. If silver closes below $80 and cannot reclaim it in the first hour of tomorrow's session, the structure shifts and the $75 to $78 zone becomes the immediate next target. Second signal, the dollar index. DXY is at 97.87 to 98.43 right now. Every full point the dollar drops from current levels removes $2 to $3 of direct headwind from silver's price mechanically. Watch for DXY to break below 97.50, as the first sign the acute safe haven flow is exhausting itself. A move from a 98 back to 96 is worth $4 to $6 on silver directly, without a single supply or demand condition changing. Third signal, The 10-year Treasury yield at 4.07% right now. Watch for a reversal below 3.95%. That threshold signals that recession risk from sustained high oil is starting to dominate the bond market's calculus. When yields drop below 3.95, the opportunity cost argument against silver softens. The institutional allocation that moved into treasuries today starts reassessing. Fourth signal, any confirmed physical action in the strait. The IRGC statement is verbal. Transition to physical enforcement is the escalation trigger. A confirmed tanker strike, a confirmed mine detection. IRGC naval vessels physically blocking a commercial vessel. Any one of those transitions the strait from threatened to actually closed. Oil reprices immediately. Silver gaps up from whatever level it is trading at when that confirmation hits. That gap is not gradual. It is the kind of move that opens $10 to $15 above the prior close in a single print. 4 signals, 4 specific numbers. Watch them in real time over the next 3 days, and you will know exactly which scenario is materializing before the mainstream media has finished writing their headline about today's crash. Now, I want to be direct about the downside risk too, because I'm not going to stand here and tell you $80 is a guaranteed floor with no risk. That is not analysis. That is cheerleading. The honest bear case is this. If the strait opens within 48 hours, the geopolitical premium fully unwinds. Silver loses the war catalyst, and if simultaneously the dollar holds above 97 for an extended period, the mechanical headwind persists. In that combination of outcomes, the $75 to $78 zone gets tested. A break of $75 with follow-through opens the $70 December consolidation level. Bank of America put their bear case fair value at $60 to $70. That model was built before China's export restriction, before the 98% delivery rate, before the 6th consecutive deficit was confirmed. The inputs have changed materially, but the institution is credible and the number exists. JP Morgan's official 2026 average forecast is $81 per ounce. That implies silver in the back half of 2026 is significantly below current prices on an average basis. If that forecast is right, the upside from here is limited for much of the year. Those are real risks. They deserve a straight acknowledgement. But here's the asymmetry that makes the risk-reward skew the way it does from $80. The bear case requires 2 things to happen simultaneously. The war premium evaporates, and the institutional physical accumulation thesis gets abandoned. That second piece requires institutions that have been buying physical silver against a confirmed 6th consecutive deficit to stop buying, against a vault draining at 785,000 ounces per day, against a China restriction cutting 30 to 40% of global refined supply, against a 98% delivery rate that has never been seen before. The bull case requires only one thing, what is already happening to continue. One case needs new information to materialize, the other needs existing information to persist. That asymmetry is why the institutional price targets, Citi at $150, BOFA at $135, JP Morgan at $6,300 on gold, implying $106 plus on silver at current ratio, are where they are. Not because those analysts are permabulls, because the structural math of the supply deficit, the China restriction, the vault drain, and the war premium all point in the same direction from $80. Let me give you one more number before I close, because I think it puts everything in today in its proper perspective. Silver is at $80 right now. Today, March 3rd, 2026. 1 year ago, silver was in the low 30s. Even at $80 after a 16% crash, after the worst single trading day in 46 years in January, after 2 separate violent corrections from all-time highs, silver is still more than 150% above where it was 12 months ago. Think about that. After everything. After the war shock, after the margin cascade, after 2 separate crashes that sent social media into full panic mode. After all of it, still up over 150% in 12 months. The people screaming that it is over today are looking at a 16% session inside a 150% year and calling it a collapse. That is not analysis. That is recency bias operating at full strength. The structural story did not break. The physical market did not break. 2 macro numbers, a currency index and a bond yield, moved because of a war. The same war that makes silver's long-term thesis stronger every day it continues. Chapter 1. Of this story is the dollar surge. You are watching it right now at $80. Chapter 2 is the inflation repricing, the medium-term consequence of $100 to $150 oil on a Fed that cannot move, the medium-term consequence of the 6th consecutive deficit, with no replenishment pipeline from Mexico or China, the medium-term consequence of institutional buyers who went to $63 and came back to $96, now seeing $80 as a second chance at a level they were willing to pay $96 for 6 days ago. The war is still happening. The Hormuz is still closed. The deficit is still running. The vault is still draining. The institutional buyers are still there. Silver is at $80. That is not the end of this story. Watch the close, watch the dollar, watch the straight. The next chapter starts in the next 72 hours.